That's right, you're watching Traders Corner on Business Day TV, and with me at the desk to take a look at the charts is Garth McKenzie, editor and founder of Traders Corner. Garth, thanks so much for your time today.
Thanks, hi Bronwyn.
So on the fundamental side, we're seeing a whole lot play out this week on the international markets. We have US-China trade talks, we still have the whole spectre of Brexit looming, and we have Fed minutes out as well. If we strip out the noise, so to speak, and we take a look at the S&P 500 chart, what is it telling you?
Yeah, certainly a lot of noise, and I think we will continue to see noise this year. I mean, you're right, all the things that you mentioned, and possibly more still to come. So it's going to be, I think the volatility that we saw last year emerging on our market is probably still going to stick around with us a bit this year as well. In terms of that S&P 500 chart, it's on the screen here now. What I keep going on about is the fact that we broke below this steep upward, or not steep, but it's the upward trend that had been defining that bullish market for the prior 2 years, really, leading up until the end of 2018. And we broke convincingly below there. Now we've had a very powerful rally off the lows. And you can see, look at that, off the 200-week moving average at the bottom there. We bottomed at 2350. And we're now pushing up, edging up towards 2,800. And you can see that this market's basically rallied in a straight line. So if we get towards 2,800 now, that would imply that we've almost had a 20% rally off the lows. And that comes on the back of a 20% drop that we saw from October last year. So very, very, very aggressive rebound that we've seen over here. What I have also mentioned on many occasions previously is the fact that we went below the 50-week moving average, and we've now been rallying up to that. Now, we have actually gone above the 50-week moving average. But I still think, let's see what happens around this 2,800 area and whether that market runs into some resistance around that. If you look at the daily chart, the resistance zone that I refer to is a little bit more easy to see here. That highlighted area is at around about 2,800. And what you'll find is the round numbers often are sticky, and you could see a little bit of noise around the round figure. Notice if we go back to October and November and even early December of last year, you can see how that 2,800 region was quite important on the S&P 500. And the market battled to get above that and ultimately sold off quite sharply. Now, I would imagine that after this aggressive bounce that we've seen off the lows, really without much of a pullback at all, you could possibly find that that 2,800 zone starts to become some resistance for the S&P 500. So I think we watch that very, very carefully in the near term and see what the market does around about that sort of area.
Because we are stripping out the noise, but reflected in that picture is perhaps commentary from the Fed. We had them strike a hawkish tone, then turn dovish, and now some analysts are saying we're going to go back to hawkish. So how do you read all of that confusion as well?
Yeah, well, this is it. It is very confusing because you're right. I mean, part of what caused this big rally that we've seen in the market over the last 6 weeks or so is that the Fed turned its tone. They were very hawkish. In other words, hawkish means they're likely to raise rates, and they're looking to, they're in an interest rate hiking cycle. And that was the expectation as we came into 2019. And then at the last Fed meeting, Jerome Powell suddenly turned his commentary a lot more dovish. In other words, saying, well, maybe we're done with interest rate hikes, and maybe we will sort of pause on the quantitative tightening thing and all that. And it was a complete 180 degrees about turn from his previous rhetoric. And the market has taken that very, very positively. Now, you're right. I mean, earlier today, I was seeing on some of the other financial networks commentary that now, because the markets are strong again and everything's happy, now he might start turning hawkish again and start warning of interest rate hikes. And I suppose, to be fair to him, he did sort of leave the door open to both possibilities. He said the Fed would be data dependent and would see what the future economic data looks like and then make a rates call from there. But it has been rather confusing to go from hawkish to dovish and maybe back to hawkish. And I saw some other commentary this morning suggesting that maybe they just abandoned the dot plot, which is the sort of the Fed's interest rate outlook looking out to future quarters. So it is all rather confusing. I suppose we've just got to trade the market we see as best we can and try and not get too sucked into all of that noise. But having said that, it's difficult because that kind of noise, that kind of commentary really does have a significant bearing on the market and how how the markets trade, actually.
You talk about, not getting sucked into the noise, but we certainly have noise here at home as well. It's going to be a busy week. We have national budget tomorrow. So let's take a look at the top 40 spot chart that you have for us.
Yeah, so we're looking at the top 40 spot as opposed to the futures for this week's show. And the reason I've gone for the spot index is just because we're looking at it over a slightly longer term period here. I like to look at the futures chart when we're looking and zooming in on sort of the recent month or 2 or 3 months of trading activity on the top 40 future. But when we're looking further back like we are here, it makes sense to look at the spot index because that is the more consistent read, or constant, shall we say, as opposed to the future, which rolls every quarter. Now, we're going back to the beginning of 2018 here, and really the purpose for going back that far is just to illustrate the fact that we're now pushing up into a fairly significant zone of resistance on the top 40 here. You can see throughout 2018 how this area between 49,000 and 49,500 provided a lot of support at that stage to the market, and then ultimately that support broke down in October of last year, and we saw a very, very aggressive sell-off into the end of October, and of course the market's been trading below that resistance zone ever since then. Now we're bumping up against that again, and not only is that resistance zone created by all the prior lows that we saw in the first half of 2018, but there's also the 200-day moving average over there. That's that green line that I'm pointing out now, and that is quite a, there's quite a confluence of resistance in that sort of area. So I think taking what I said about the S&P 500 and the 2800 overhead resistance area, putting all of this together, I think it does suggest a little bit of caution just in the near term, I think, and chasing long action here is probably something I wouldn't be doing at this point in time.
Okay, so then let's revisit last week's trade. It was clicks. We were hoping to take advantage of the trading opportunity that presented itself as a result of their book build. It wasn't so successful for us. We were stopped out. So walk us through what happened there.
Yes, it's unfortunate that we were stopped out here. We went long 450 CFDs at 184 Rand last week. And the reason for doing that was, as you said, there was a book build. Effectively, what happened was the Clicks Employee Share Ownership Trust needed to sell off a block of 7.8 million shares. They did it via an accelerated book build at 184 Rand per share. And typically what we see in these types of situations is you get a short-term move lower in the share price, but then you generally get a recovery quite soon thereafter. And even last year, we had almost an identical situation in Clicks, which we looked at on the show last week. And it provided a great trading opportunity. Unfortunately, this time it didn't work out, and we were stopped out. Our stop loss was moved below 179 Rand. I ended up stopping out that trade at 178.53. When I looked at my phone a moment ago, I see it's now trading down towards 172. So I suppose we can
just as well
be glad we got out. I mean, and then that is the thing with stop losses. In my experience, very often you end up being pleased that you were stopped out because it could have gotten worse, which it would have done in this case here. So as much as we lost money, we lost 2,785 Rand, it is within our risk parameters. We set out to not lose more than 1.5% on this trade with a little bit of transaction costs and a bit of slippage in the price. We've come out with a loss slightly bigger than that, but the reality is we don't lose more than 2% of our capital here, which is always the number that I kind of like to cap a loss at. Never to lose more than 2% of our capital on any one trade. So it's well within the parameters here. It is unfortunate, but it's one of those things. And in trading, you're never going to get all your trades right. The key to the success, and certainly to the success that we've had on this show, is to ensure that when you do lose money, you just lose a little bit.
Keep it contained.
Yeah, keep it contained. Don't let losses get out of hand, and let the winners take care of themselves.
So when we were talking about the top 40, you said, there's a little bit of caution in the market, and that's why we're not really entering a trade this week as well. Budget certainly tomorrow, looming quite large, but you are keeping your eye out on the Rand-dollar exchange rate. We have seen that come under pressure recently because of the crisis at Eskom. Yeah. So take us through the Rand-dollar there and kind of explain what we're looking out for.
Yeah, the Rand is very topical at the moment because of the fact that it has weakened. I mean, since the beginning of February to now, the Rand is 7% weaker over the month to date. So it's quite a swift move. And from a technical perspective, the move towards 14 Rand 25 on the Rand dollar exchange rate is meaningful. You can see it on the chart over there. Notice that downward trend that comes in, joining all the lows since September of last year. That trend line comes in at 14 Rand 25. And then, of course, you've got the lower boundaries there joining the bottom of that sort of channel type of structure. So from a technical perspective, this 14 Rand 25 area is significant. If we were to start breaking through there, then that could spell potential for further weakness in the Rand. But we'll have to give it time to see what it does. You mentioned the budget, and obviously this budget is going to be very, very closely watched because we all want to see what sort of decisions are going to be taken around Eskom, how much of Eskom's debt is the government going to take on, what are all these going to mean for growth potential.
For ratings.
Ratings, exactly. I mean, Moody's is going to be really glued to their screens watching this budget speech because Tito Mbowene's got a very, very tough balancing act to try and walk in order to try and get the situation right and to save Eskom, but also to avoid threatening our sovereign rating.
Yeah.
And I don't know that it's possible to achieve both things, quite frankly, but let's see what he comes up with at the budget speech tomorrow and what the reaction will be in the currency. But, you know, I think if there's not an outcome to the budget which is satisfactory to Moody's, the market may start to look ahead and begin to price in a potential ratings downgrade. And that could also then come with the possibility that you see the Rand starting to weaken through that 14.25 area. So that's why I flag it this week, because I think it's very topical and it's very important as we go into the budget speech tomorrow to keep an eye on this chart.
Okay, so we'll be keeping an eye on that. In the meantime, though, you've got a couple of courses coming up. If viewers want to know more, before we get there, let's check in on the portfolio.
Yeah, so our South African portfolio unfortunately has gone slightly into the red now for the year to date. Following that loss that we took on the clicks trade, only down 0.73% for the year to date. It's very early in the year, so I'm not massively worried about that. We continue to do our best. And then the offshore portfolio, we've still got our General Motors put options there, which are not really doing all that well for us at the moment. There's a loss of $152 there at the moment, so down 1% for the year to date on that offshore portfolio as things stand. And then the courses that you mentioned.
Yes.
I've done two recently. I've completed a course in Joburg and I was in Cape Town this past weekend. I've got one more course left in this series, which is on the 9th of March in Durban. So if anyone would like to attend that, they're welcome to email me, garth@traderscorner.co.za, and I'll email you all the details.
Garth, also just remind viewers how they can sign up for the weekly newsletter.
Yeah, if you go to traderscorner.co.za and you go to the middle of the page, there you'll see a link for a free weekly email. Click on that, enter your details, and then what we'll do is send you an email every Tuesday detailing exactly what is coming up on this show each week.
Garth, thanks so much for your time as always.
Thanks.
Garth McKenzie is editor and founder of Traders Corner.